Hey everyone, welcome back to our corporate action series. I'm Viraj Taral. This is the 7th episode and today we are diving into an exciting topic, buybacks. If you are new to this series, don't forget to check out our earlier videos where we discussed dividends, right issues and much more. But for now, let's talk buyback and why companies repurchase their shares. So let's get started. So what exactly is buyback? In simple term, a buyback, also known as a shares repurchase, is when company buys back its own shares from the market. So this reduces the number of outstanding shares and can be a way of companies to return cash to shareholders. Imagine a pizza is divided into slices. If company buys back some of those slices, the remaining slices become larger, meaning each shareholder's stake in that company increases. Sounds good, right? Now let's break down the two main types of buyback. First is open market buyback and second is tender offer buyback. So let's first look at open market buyback. So this is most common form where the company buys its shares directly from the open market over a period of time. So this method is flexible, but the buyback price is market dependent. In the second, tender offer buyback, in this method, the company offers to repurchase a specific number of shares at the predetermined price directly from the shareholders. So it's usually higher than the market price to incentivize shareholders to sell. Alright, now you are probably wondering why companies even bother with the buybacks. Let's look at some reasons. Boost shareholder value. So by reducing the number of outstanding shares, buyback can increase earning per share, EPS. So it's like dividing the company's profit among fewer shareholders, making each share more valuable. Second is signal confidence. So buyback can signal the investor that company believes its stock is undervalued. So it's a way of saving and we are confident in our future growth. Third is improving financial ratios. So buybacks can improve key financial ratios like return on equity, ROE, making the companies more attractive to the investor. And fourth is flexibility over dividends. So unlike dividends, which create expectations for regular payment, buybacks are more flexible. So company can repurchase shares when it has extra cash without committing to a long-term payout. So what does all of this mean for you as a shareholder? Number one, increase in share value. So if done right, buyback can push the stock price higher, so benefiting those who hold on their shares. Second is tax efficiency. So for some investor, buybacks can be a more tax efficient than dividends, especially in the market where capital gains are taxed lower than the dividend income. And third is dilution control. So buyback helps prevent dilution of ownership, especially after issuing stock options or convertible security. Now let's take a quick look at some of the real world examples, particularly in the Indian market. Tata Consultancy Services, TCS. So TCS has been known for a regular buyback to the returns to the shareholders. In fact, TCS buybacks have often led to a boost in the stock prices. Second example is Wipro, another IT giant. So recently conducted a buybacks returning a portion of its surplus cash to its investor. So these buybacks are example of how Indian companies use share purchases to enhance shareholders' value. Now not everything is sunshine and rainbows with the buyback. There are some risks involved too. So first risk is overvalued buyback. If company purchases its shares when they are overpriced, it could hurt a long-term value. So they may spend too much on share that might eventually lose value. Second is short-term gain, long-term pain. Sometimes company use buyback as a quick fix to boost their stock price without focusing on the long-term growth. So this can lead to under investment in the core business areas. Alright, let's wrap this up with some key takeaways about buyback. Buyback reduces the number of shares outstanding and often boosting the stock prices. Second is, they can increase earning per share EPS and improve financial ratio. And third is, not all buybacks are beneficial. So overpaying of shares or using them as a short-term fix can be a risky. So ultimately, buyback is one of many tools a company uses to manage its capital. So the key for the investors to use or evaluate why company is doing it and whether it is truly adds value in the long term. Then that's it for today's video on the buyback. If you found this helpful, don't forget to give this video thumbs up, share it with others who might benefit, and subscribe to this channel so you don't miss out any next episode in the corporate action series. Comment below if you have any questions or suggestions for the future topics. Thanks for watching and see you in the next video.